All right, welcome to Business as Unusual 2023. We have a very exciting season in store, and we're starting with helping you understand the economic scenarios you need to prepare for in 2023. So, we're going to get started in just a few minutes, but just a couple of housekeeping items. If you're attending via our live stream, Dana Kramer will be managing the chat. So, please feel free to add your questions, and she will feed them to myself and the panelists today. I'm Kathy Steele, and I'm the CEO of Red Caffeine and your host today. So, for those unfamiliar with Red Caffeine, we are a growth consultancy, and it is our mission to build badass brands that people want to work with and for. So, why does market volatility matter to your business? As leaders, while we know we can't control those broad factors, it is our responsibility to make data driven decisions to maintain the health and profitability of our organization. So, as a growth consultancy, Red Caffeine looks at macroeconomic forecasts and global trends to help our clients build a go to market strategy that strategically addresses things like staffing, cost management, sales, and investment in technology. Our panel of industry experts are here today to help you understand the market conditions. So if your company is planning to grow this year, you'll know where to place your bets over the next 12 months. So let's jump in first. I would like to introduce our guest of panelists, starting with Terry. Terry is Managing Director at Prairie Capital Advisors and a second-time guest on Business as Unusual. Thanks for joining us again, Terry.
Thank
He
you.
focuses on mergers and acquisitions and capital advisory engagements. In this role, he assists middle market business owners in understanding and assessing their strategic business alternatives and developing and executing transaction solutions to meet an owner's objectives. Additionally, he works with family, management owned, and private equity owned businesses and helps these clients address their growth and ownership transition issues, including exiting, recapitalizations, M&A, company sales, and ESOPs. With valuations and deal volumes in decline over the second half of 2022, we'll talk to Terry about whether this is a good time to consider acquisition as part of your growth strategy. Second, we have Spencer Yurkowitz joining us from STRAT. And Spencer is a research analyst and supports the firm's capabilities by performing in-depth analysis on investment managers, including analyzing manager style, strategy, and execution. Spencer evaluates a fund's ability to generate desired investment returns and suggests managers to be included in client portfolios. Spencer also assists in developing the firm's economic and financial market outlook, which I just find always really interesting and informative. Spencer will step us through CapStrat's investment framework to explain how 2022 ended, and then we'll learn what asset classes make sense to consider in our portfolios right now. Thank you for joining us, Spencer.
Thank you, Kathy. Looking forward to it.
And then Jason Turner is the Chief Investment Strategist of Great Lake Advisors and our bank, Wintrust. He is a member of the firm's investment committee, authors market and economic commentary, regularly presents in the media at professional conferences, and works with client portfolio managers to support institutional and private clients. As the head of multi-asset strategy, he's responsible for portfolio strategy, asset allocation, and overseeing the firm's managers' due diligence and selection efforts. He is also a member of the firm's operating committee and management committee. So a lot of exciting experiences to share with you today, but we're going to get started with Jason. So Jason, the economy has been on a roller coaster ride for the past few years. Some experts are believing that we're already in a recession. Others disagree that but it's only about timing. And then people are talking about whether to expect a soft or hard landing. All right, what do we do? It feels like it's changing every day. So can you take us through, the current economic overview?
Sure, and we can delve into it. Start with that first slide on inflation. Has been the big economic story over the 18 months, even as we saw a rise in inflation in 2022, rising far and above. 90s run about 2.6%. We closed the after peaking at over 9. Putting that in better context, though, is not cheap. But on the next slide, you can see what the average was for the last cycle from the 08-09 economic downturn oriented recession in 2020. Paints and where we started was an inflation level at just 1 point. Fed targets 2% for inflation, and only 1.6% on average. Really, the price movement over the last decade, the prior couple of decades, and we can see that things apart. And inflation on the next slide over the one, certainly seen some areas of runaway inflation. Pull up over 13%. Food 11%. The only area we see in trucks, and that was an area that we saw spike up in amid shortages in the supply chain, prices there recede. So as inflation has come down, we're starting to see some of those early movers come down. Those stronger movers from early in 2022 start to painting a better picture, though, on the next slide. Inflation since 2009. Inflation since 2009. If you look at the analyzed column, that really shows us that it's 2% target in a couple of key areas in energy services. In effect, that's what we've experienced nearly 10 years worth of catch-up inflation, and that's been very, very uncomfortable. Economically destabilized. To a viewpoint on the employment market, we can see that employment markets have significantly. The unemployment rate sitting at 3.5% before the pandemic. It has been on that low for much of, and we continue to look.
Jason, I hate to interrupt you, but we are having some trouble with your volume, so I'd love to see if we can sort of get it back on track. I know it's we're hearing just about every other word. Can you maybe switch gears on your sound?
Sure. How does that?
Well, why don't you try and kind of get back on track? I think everybody, we're starting to get messages from the attendees. Yeah, there we go.
Okay, is this any better?
Oh, much better. All right, we're back on track. Love technology.
Excellent. Do you want me to backtrack or just?
Yeah, why don't you backtrack a bit? So should we start back at? Yeah, that would be great.
Sure. We can back up and look at where we were from 19 to 2.6%. Sit now at 7.1%. This is significant, lower than it was earlier in 2022. Obviously, than the average. Slide forward, though, and putting this into context, cycle from the end of the 08-09 to the 2020 pandemic, we saw an average inflation rate on that next percent. And 1.6 to the Fed's 2% target. And that 2% to move an economy forward. A little bit of much inflation is bad. Deflation, prices moving forward little by little. Moving yet another slide forward, the consumer price inflation over 1 year. One more step there on the slide.
So,
and we can see
maybe
yes,
you were still struggling with the volume. So I don't know if you've got another sound access. I can't tell if you're on AirPods still, but
Let's see if that's any better.
Sounded a little bit jumpy still, but let's try it.
From a 1 year ahead perspective, it went down in some areas. Used cars, for example, is an area that we saw as a canary in the coal rising inflation. That has now seen prices recede by 3% over the trailing. We still see elevated levels in energy, up over 13%, food up over 10%, levels we saw earlier this year. So we're either seeing a plateauing or a inflation. Shelter is one of the lone holdouts. Shelter continues to march higher as through a calculation called owner's equivalent rent. The home price increases years. That phenomenon likely works its way through inflation in the March-April time frame to see that turnover as well. Putting it again into a different context, see that consumer price inflation since 2009 on an annual in many areas is just above that Fed target, just above 2% on that. And that tells us a little bit insight or intelligence. The Federal Reserve's slow action in 2021 in addressing that monetary policy stance until March first hadn't quite reached those annualized levels. We've been catching up to that we missed, but now we rapidly saw that rise on target. In terms of reset on where we stand in the economy on employment markets. Markets on the next slide have seen a unemployment rate despite economic difficulty in 2022 and volatile stock market near for much of the half of this year. We could step the slides forward again. Let's go one more as well to try to explain somewhat employment that we've seen, yet the difficulty we're having in hiring or have been having in hiring. Labor force participation is one area we look at closely. We were at a high of over 63 before the pandemic. We dropped to 60% in the depths of the pandemic, and have only recovered to a number that might seem like a number that's pretty close, 63 to 62%, but in reality, that's 1% inflation counts for some near 4 million people. That 1%, so that's just within 1 percentage point. I would argue that this is as good as it's going to get from a labor perspective. We passed peak baby boom retirement during the depths of the pandemic. We missed that headline into all those headlines around COVID. But also we've seen, as we have seen in other periods in employment markets, a number of people decide to retire early. So I look at that bottom force participation from ages 25 to 54 to get an insight on where we stand. We 1.5% of that age demographic participating in the labor force. We're at 80 day, above that average. And that's part of the reason why I feel we're not going to get the labor force to aid in addressing some of those hiring concerns. You can see where those hiring concerns have led us. We have seen a large total job opening, although that's pulled back from the near 12 million peak it was at before. One step. The level of 10.4 million job openings that we sit at today certainly level. But if we forecast rate of growth for the 5 years, we pretend that it happened, we'd be sitting at 10.9 million job openings. It's an outcome of the need for the American economy in terms of labor, and that continue to grow the economy has been the persistent theme since really 2014. We'll take one more step of the sum of this back together. So let's tie wages and inflation together. And if we take one step slides now, it should be on that slide, and inflation. We see the unemployment rate, the consumer price index is 7.1%. And now we've seen average employees on a basis up 4.6. It's off its peak nearly. And importantly, we've seen not the same relationship between average and the unemployment rate that we saw pre-pandemic. When you see the unemployment rate go down, earnings typically go up, meaning less employees pay more for the employee, and the odds up, hourly earnings go down in times of higher availability of employees much. We've seen the average hourly earnings here in 2022 track more closely to inflation. As inflation has rolled, so has average. We're not seeing a lot of wind currently. Picture to the inflation expectation slide. That inflation expectation is an important part of pushing inflation higher too, and part of the case why we don't think that inflation has to continue to run. That inflation expectation right now for consumers in the year ahead is 5%. 1 year from now, and we said again a little over 7%. Long-term outlook, either from the bond market or consumers, telling us we're getting back into the 2% range for inflation. That difference in expectations on a go-forward basis tells us that the consumer inflation is going to fall in the future. Inflation expectations can be a source of sticky wages, inflation, and with expectations trending downward, we do not expect patients to push inflation higher as they did earlier this year. Connections to make for you, and that's the individual consumer. On the slide, you can see that at a point in 2022, or from where you're at, personal spending outpaced personal income. This is telling us that the average American consumer, and it's hard, consumer spending and ownership, it's very hard to turn in a short period of time. So as income, it takes a while for spending to react. And we have seen over the back course of 20 outpace incomes. And what does that lead to? And we can see that on one more on credit and savings. We've seen the personal Americans are putting away declined to just 2.7%. Before the pandemic, we even saw this number peak in the mid 20% range as we got the first stimulus in terms of fiscal stimulus. With savings depleted and Americans not saving even at the rate we have seen a corresponding increase in the use of consumer credit. So while and it's been higher throughout 2022, it's increasingly being fueled by credit. And that's an important concept because that's an inflection point we usually see of a recession. Usually, Americans take a little bit longer to react in terms of changing than their income or savings has changed in the near past. Dynamic shift, we typically see those windows occur. And you can even see it here in the chart. Back, and you can see the increase in consumer credit over and above the savings rate back then as well. Idea of what has really driven the economy from inflation, employment, consumer viewpoint, and that incredible reaction on the next slide of the Federal Reserve in terms of this slide that quite honestly looks like the mountain climber from Price is Right, stair step up. We saw 4 consecutive 75 basis point hikes from the Fed in the middle of last year. I have to go back to the early 1990s to even find one 70. The unprecedented nature of the rapid rise in the federal funds rate, a focus on fighting inflation has been the overriding policy story of 2020. Fed's comments from December, they remain committed to an aggressive monetary action until inflation is tamped down completely. Why we would expect the Fed to continue to the early part of 2023 before hopefully taking a pause after either the February or evaluate the economic impact of their significant increase in monetary policy. So hopefully level set of where we stand from an economic perspective in terms of a current outlook. Touch on the outlook for 2023 forward.
So Jason, we still had a lot of connectivity issues. Is there a way to kind of boil it down to a couple of key points for business leaders?
Absolutely. From a key perspective, inflation has been high and has been a problem, but is a problem that's going to resolve probably faster. As inflation resolves itself, Fed policy should level off, rates come down in any meaningful way for the balance of the year. Income will continue to be challenged from an availability of labor perspective, although wage price. So a takeaway perspective, inflation, a resolving problem, the employment market still pressures receding to some extent, and Fed policy lining up along with consumer in advance of cyclical recessions.
All right. Well, thanks. I know it was a lot of, I appreciate everybody bearing with us. I know there was some challenge in the sound, but we are going to switch gears and have Spencer start to take us through how these factors are going to impact the, people's personal investment strategies.
Definitely. And Jason hit on a lot of good points related to markets and the economy. And we're going to expand on that and talk about the overall macro setup for 2023. So our macro framework is extremely important. It helps give us a perspective on how to position portfolios and investments going forward. And the first piece of that is looking at the underlying conditions surrounding us. So there are four inputs to our framework that matter. Those things are liquidity, inflation, economic growth, and recession. So we take each of these four inputs and we look at a combination of two things. One is the levels. That means we're looking at each of these inputs and comparing it to their long-term trends in order to determine, is this variable relatively high relative to history or relatively low relative to history? So once we establish whether that variable is high or low, the next step is to see where each of these things are headed. Is it going to be rising over the next 12 months, or is it going to be falling over that time period? So that's extremely valuable for managing portfolios in terms of we can transition that and look at how asset classes perform in each of those macro environments. Also provides great insights for businesses in terms of the type of economic conditions surrounding that environment. You'll see the last component in step 3 here is prices. Prices obviously change every day, every second for something like stocks. But the general idea here is to look at prices relative to where they've been. And that way you can determine attractive entry points for any type of position you're looking to get into. So we'll start up at the top with step 1, and that's over on the next slide with liquidity. So when we talk about liquidity, what we really mean is the growth rate of the money supply. The money supply is really the plumbing of the financial system, matters for both financial conditions for investing and also for financial conditions for businesses. So here what we're looking at is a chart of money supply growth in the United States, so the year-over-year change. And you can see coming out of COVID-19, that recession there, sort of on the right-hand side of the page here, we had record money supply growth. More money was created in a shorter time period in history than ever before. And over a third of all US dollars in existence today were created during that time. So money supply during that time, definitely high. And there was a lot of money, and money was growing in the economy during that time. So money supply high and rising. That was because of all the things the Federal Reserve was doing. They were cutting interest rates to zero, unprecedented fiscal stimulus, and even stimulus like the CARES Act. When all those things happened, the stock market quickly recovered because there was just so much money in the economy. It had to go somewhere, and the economy was closed. So transitioning from that point to where we are today, we ended 2022 with the exact opposite of that, the lowest money supply growth in history, basically at 0%. And that can explain a little bit of what happened in 2022, pretty tough market environment. You'll also see our forecast tacked on to the end here in that light blue line. And we believe that we're going to be transitioning now to a low liquidity environment, which is historically a very difficult environment for markets in the economy. There just isn't enough money left to continue to bid up both the economy and stock prices. So you might be looking at this chart and thinking, what's caused this extremely dramatic shift? We had the highest money supply growth ever and now the lowest. Well, it's because of what the Federal Reserve is doing to fight inflation. And that's the next key input in our framework over on the next slide. What you'll see here, similar style chart. We have the 1 year change in prices in the blue line, and the 1 year change in prices except for food and energy in the green line. Overlaid on that is the long-term trend line in gray. What we've been in for the past 2 years or so had been a high and rising inflationary environment. And high and rising inflation is a really difficult environment for bonds. It can be a challenging environment for stocks as well. The reason being that when inflation is coming in hotter than expected, that pushes up bond yields, pushes up interest rates, and that's a bad environment for bonds in the short term as the inverse relationship between yields and prices. And then you also have stocks looking relatively less attractive going forward once bonds have appreciated during that time. So you'll see our dash line for our forecast tacked on here as well, forecasting 4.3% for core inflation and about 4.2% for headline to end the year. So what does that mean? There's some good news and bad news here. We received signs, at the end of 2022, that we were transitioning to this regime of high and falling inflation. And the good news is that's historically been a good environment for fixed income. Yields tend to come down in that environment. The Federal Reserve may be able to pause some of their rate hikes over once inflation is coming down at that point. So it tends to be a pretty good environment for bonds. But the bad news is that inflation is still high. So we're forecasting that the Fed is going to have to hike rates a couple more times in 2023 and probably keep them there for the remainder of the year. The reason being that they're trying to keep that money supply low in order to take down inflation. So the Fed is going to continue hiking rates in order to combat inflation, and that has implications for the next factor in our framework, which is economic growth. If you could go over to the next page here, we've got real GDP here. So real GDP measures the overall growth of the economy after you take out price increases from inflation. So what we have here, consensus estimates for real GDP in 2022, and that's the dark blue line. And then in the light blue line, GDP estimates for 2023. And you'll see that estimates over this time period, over the last 12 months, have really just been trending downwards the whole time. So now we're at the point where GDP for 2022, once we get the final fourth quarter number, is expected to be near zero, about 0.4%. And growth for next year now expected, or for this year, for 2023, expected to be near zero. And for context, the long-term average here is about 2.5 or 3% or so. So putting these things, two things together, entering what we expect to be a low and falling growth environment. To add some more context in here, we added red and green bars over on the overlaying the chart as well, which is the economic surprise index. So green bars indicating economic data coming in better than expected, and red bars indicating the economy is doing worse than expected. You'll see that growth expectations really fell during those summer months last year. A lot of that driven by the real estate sector, home prices really significantly impacted by changes in interest rates. With growth estimates really falling over the entirety of the course of last year, we've been very closely monitoring our recession indicator over on the next slide in the last piece of our macro frame. So our recession indicator takes into account key market economic data points, as well as uses other recession forecasts to create essentially a composite recession forecast. So we can blend all of these things together to create a forecast for a probability of recession over 5 unique time periods here. The blue line that you'll see on the chart is the composite probability, so a combination of all those 5 time periods. Where we ended 2022 was that there was a relatively low probability of recession, that the economy was in a recession at that point in time. I'm sure a few of you out there have seen articles about companies slowing down their hiring or cutting back on their workforce. But overall, the labor market is in a relatively healthy position right now in terms of unemployment, ending the year near its all-time lows. And in the U.S., as long as people still have their jobs, they're going to go out and spend their money in the economy. However, despite the strength in the labor market, there is an elevated probability of recession over the next 3 to 6 months in the near term. Right now, we have about a 60% probability of a recession starting in the next 6 months. It's no surprise that recessions are a very key input for the macro environment, given recessions are pretty difficult for most asset classes. It can be a tough environment for businesses as well, as they see a few less orders come in than they might have been seeing last year. If you could go to the next slide, we brought one more page just to dig into some of the components of the recession indicator and expand on this of where those probabilities are coming from. So you'll see the forecast horizon and data point listed on the far left-hand side of the chart of the table. And on the far right-hand side of the chart, the most recent data point or most recent measure that we have available with the red, orange, and green indicators indicating how much it's contributing to that recession probability. So really, there's only a few data points still left in the green that are saying that we aren't in a recession, and that is heavy vehicle sales in the labor market. Vehicle sales really just recovering from market shocks in 2021 with some of the supply chain issues there and supply chains coming back online. And then you'll also see towards the bottom of the page those 2 green numbers for the SOM and Piger indicators. The SOM recession indicator is based on the unemployment rates, obviously driven by the labor market, and that's saying low probability of recession right now. And the Piger indicator, also based on the labor market and utilizing some additional data like payrolls and manufacturing sales. Those 2 data points signaling that we're not in a recession right now. So putting in all the pieces together here, started with liquidity, the money supply growth, hit the lowest level at the end of the year in 2022, and no meaningful growth in the money supply is expected next year. Money supply growth was so low because the Fed has been trying to fight inflation. So they've been raising interest rates and reducing the size of their balance sheet. Inflation is public enemy number 1. So the Fed is really slamming on their brakes right now to try to stop that. Even though inflation is high, it's expected to come down to levels that the Fed will be able to stop hiking interest rates at some point in 2023. Definitely affected areas of the economy like real estate last year, which drove growth lower in 2022. It's likely to lead to lower growth in 2023 as well, with a recession very probable in the next 3 to 6 months. In terms of asset class performance, stocks expected to stay in a difficult macro environment for pretty much the entirety of the year. Recession probability and low liquidity, the key drivers there. However, there's definitely a brighter picture ahead for fixed income or for bonds, expected to be in one of their strongest macro environments than what we've seen in like the last 10 years. And that's due to high and falling inflation, which is good for bonds, expecting interest rates to peak out, maybe even start coming down a little bit, And low and falling growth also tends to be good for fixed income as people sort of seek safety in some of those safer, less risky assets. So I'll leave you with that. Even though the year ahead may be challenging in terms of the macro environment, definitely still opportunities in terms of how we position portfolios, and in terms of how businesses stay on top of some of these trends.
So it sounds a bit like it's going to be the year of the bond, from what you're saying, and then it's a little bit sector driven. It looks like there's some hopeful things going on in manufacturing in some select sectors, where other sectors are going to have more negative kind of performance. Is there anything else? I feel like it's a little confusing with the employment numbers being so low, with with unemployment being so low. It sends a signal to leaders that we still should be investing in our talent strategies, although on the flip side, we're seeing a lot of layoffs and those types of things. So any follow-up commentary on that, Spencer?
Yeah, I could definitely add some comments there, and great questions. So first, starting with, is it going to be the year of the bond market? So in terms of, performance expectations for the bond market next year, one thing that is somewhat underappreciated with bonds is that, as they go through tough time periods like they did last year, arguably 2022 was one of the worst years for fixed income, in recent history. But that spells a better environment going forward for bonds. Bonds are fixed payments. So even when, the price of bonds fall and you get negative returns in your portfolio, that also means the yield of that bond just went up. So you can, in this environment where, you can get a 4% yield on a high quality government bond, that's definitely an attractive environment for the bond market going forward. Probably, one of the strongest environments than over the last 10 years or so. In terms of how, we might expect different sectors to perform over this next year, it's definitely the type of thing where it depends on the type of industry and space you're in. But in terms of, what we can suggest is this is one scenario, the most likely scenario that we see going forward. However, it's important to just have your playbook ready for this year in terms of, markets move fast, the economy moves fast, and things can change. So to just be ready for, any type of outcome, depending on, where each of these four inputs trend over the next 12 months.
Thank you. Thanks for that. All right, Terry, why don't you bring it home? As we kind of talked about in the intro, the deal volume and activities have been a bit declining, but there's still some really positive information in the merger and acquisition space. So take us through some of that data.
Sure. Yeah. So this first chart here just goes through the M&A volume by quarter since before the pandemic in 2017. And really specifically, if you look at the year 2021, that turned out to be a record year, like the all-time record year in global M&A as well as U.S. M&A and in middle market M&A here in the United States as well. And so 2021, after the pandemic, was really something that was extraordinary. And I think everybody in the deal business, including business owners, kind of thought, okay, this is really easy. I can sell anytime I want and get a high value. And so I think we're going and trending toward more of a traditional M&A market. And you can see this year, 2022, first quarter was about equal to 2021's last year's first quarter. And so that was a record year. And so we started off the year maybe with some expectations that we were going to continue that. But if you think about it, we had an invasion of Ukraine by Russia early in the year. We had a resulting energy market disruption. We had continuing supply chain issues. And then we had big declines in equity. The equity markets and all of the markets were pretty volatile. Inflation became a bigger factor, and I think the two economists went through some of the reasoning for that. But I think there was both Fed policy as well as Congress kind of tinkering a little bit too much, putting too much fuel on an already raging fire. And then as a result, we got high interest rates. And so basically, a lot of those factors happened, but the results are yet to be seen in the M&A market. I would say business sentiment right now, and I always look at something called the NFIB. I think it's the National Federation of Independent Businesses. They do a monthly tracking, and they've had for the last 12 months negative business sentiment. And the most recent one came out in December, and it was a continuation of that. So businesses aren't feeling really good. And then same thing with the consumer sentiment, which is the University of Michigan survey. That is pretty low right now, although in I think the most recent one, it popped up a little bit, but it's still nowhere near the highs that once were there. And so basically, deal volume, if you look at the aggregation of this, is down about 20% over last year. And the number of deals also is down about the same. So, you might say, well, gosh, I just heard two economists talk negatively. Now Terry's talking negatively. What's going on here? And I would say there's still many M&A deals done. And if you look at the last bar that's shown here, Q3, that represents about 733 deals. And so somebody is selling things and somebody is buying things. And maybe it's not as many as were, a couple quarters ago, but it's still happening. And so I think it's a time to be optimistic if you've got the right characteristics of a deal or a business, to engage in M&A. So I'm pretty optimistic. Cycle to the next slide. A couple of questions here, or a couple of comments here, is private equity funds basically now are the largest owner category of businesses in the United States other than individual business owners. Okay, and just in perspective, there are about almost 3 times as many private equity owned businesses now as there are public companies.
Wow.
And so just think about that for a moment. Private equity is a big factor here. And so it's one of the things that we monitor closely. The takeaway, though, on this chart, though, is like the other chart, which is overall M&A volume, the volume of private equity sales, exits, has also declined. And if you think about it, these are the professional business buyers and sellers, and they sell and buy when it makes sense to do so. And if they're not selling, or diminishing their sales, maybe that's a signal some business owners should take. But the only thing I would say is keep in mind there still are a lot of companies being sold, even by private equity funds. And so once again, the private equity community, even though they're pulling back a little bit, they're still selling. And then also, if I had another slide up, I don't have it, but they're also doing a lot of buying as well, which brings me back to what PEs represent. And depending on how you measure what private equity funds have to invest to deploy, it's somewhere between $1 and $3 trillion of capital. That's in funds waiting to go out. And most equity funds are time limited, meaning they have a 7 to 10 year time period in which to invest that. And so again, they are deal machines. They're hungry. They got mechanisms set up. They're constantly looking for new deals. And so, that's another characteristic that I look at, that's a positive, is there's always going to be deals because there's always private equity funds. And then there are also strategic acquirers as well. And I'll comment on that in a slide or two more. Advance to the next slide. So the rules of supply and demand affect the M&A market as well. And so when the supply of deals is down, the demand is still pretty consistent, with private equity funds having to deploy. And so valuations are the equalizer, to make the laws of supply and demand come into balance. And so you can see that these bars, which represent small deals in the yellow bars, the middle bar is green, or the middle-sized deals, and then large deals are the dark bar. But you can see that valuations, even with the events of this year, have been sustained pretty well. And in fact, in the third quarter of this year, of 2022 rather, they've actually climbed. And I think there's a little bit of a measure of supply and demand in that. And then the dark bar is large deals. And that's where interest rates have started to have an effect. Basically, because of the Fed policy, interest rates have risen. As a result, debt service costs by companies or for companies have increased. And so, therefore, the riskiness of those companies has increased. And that's led to a commensurate pullback, if you will, by the lending community, commercial banks, business development corps, other types of debt funds. And so, because they work mostly with large deals, you can see that there's been a negative impact already in the third quarter to valuations for large deals because of financing. Smaller deals do not have that same thing because they're usually going to one bank, and it's easier to round out a financing package if you're talking to maybe 10 banks and all you need is one to really like the deal. Whereas if you do a big deal, you need to syndicate the deal if you're doing 200 million. And so therefore you need maybe 5 or 6 banks to agree, and it's harder to do that. And so this is an early warning signal maybe that the financing issues might migrate to the lower end of the deal market, that is. But the important thing here is there's still deals being done at some pretty nice valuations. And just to comment on our data here is we are right now in the middle of January, and the data sources that we use, it takes about a quarter for them to collect it. And so the reason we don't have fourth quarter data available is that it's being collected now. Now I do have preliminary data, and basically a lot of the trends I'm speaking of are starting to show like a further decline in M&A volumes. And we're seeing a little bit of a decline in the valuation metrics by size on this slide. So anyhow, valuations takeaway on this slide are still pretty good. And I think there are still pretty good opportunities for buyers or for sellers to sell their companies and then for buyers to buy companies as well. Cycle to the next slide.
So Terry, really quick, I guess I would have been allowed to think that this would be a good time to buy. That there would be, lowered valuations coming. But it sounds like just because of the supply and demand situation that that we're going to see valuations still hold pretty strong. Or
Yes.
is that what you're
Yeah.
predicting?
Well, I would say the way the M&A market has evolved over the last, say, 20 or 30 years is there are a lot more people like me, M&A advisors out there. And so there's a careful process. We put a competition in place, to set one buyer off another. So, I mean, there's a pretty strong, ability to keep valuations high if it makes sense. Now, a couple of things too, and this is an important point, is there are two parts to evaluation. Number one is the multiple, and that's what we just looked at, and we're looking at it here, and I'll comment on Strategist on this. But the other one is earnings. And so in an inflationary environment, some businesses are having some earnings difficulties. And we're starting to see that a little bit in the public markets now. It's earnings season, and there have been some disappointments, some downward guidance, et cetera. And so even if the multiples are kept at the same level, but the earnings suffered, the multiple times the lower earning means a lower dollar valuation. And so, we're going to see a lot of dynamics that are going to intermix, I think, going forward. And the other thing too, Kathy, is there's always a lag, as there always is. Sellers still think, it's 2021. And so they want those values. And
Right.
buyer or seller expectations are still high. Buyer expectations are low, and then the mix is kind of like willing buyer, willing seller, and how you end up. So this slide really addresses strategics versus private equity. And so financial buyers, the private equity funds, are the light green bar. Strategics are the green bar. And we noted in our data over the last, say, year and a half or so, that the strategic community still very active in the M&A market, but less likely over the last 18 months to pay up for a deal. And so there was more of an equalization, and you can see that 2021 and then the first 2 quarters of 2022, where there was about equal or close enough to be called equal. The reason for that is our theory was that a lot of strategics, while they wanted to buy things, they weren't going to pay up for them because they were already having a lot of the supply chain, inflation, all sorts of issues within their own business. And why would I go and pay up for something and double down on all my risks? And so they became a little more conservative in the offers. But, the third quarter of 2022, that just all the shackles came off the strategics and they started bidding up again. And I think there's a little measure on the private equity side of maybe less aggressiveness on private equity funds, again, because of financing issues as well. But the valuations, even on that bar, are still relatively high. Now, one thing it's important to realize is that strategic acquirers make up about 70% of all deals. And so even though private equity funds are in a growing and emerging big category of owners, strategic acquirers still make up a big part of that. And that's a business that's already in the business that they're acquiring, if you follow that. So, and so I guess the message on this slide is basically, if you're selling your company, you got to think like a buyer and try to find those strategics, because that's where you're going to get some value appreciation. And then, like I said, the emerging issues are probably going to affect this slide the most. And so the next quarter, when we release the data, you'll probably see kind of a decline in valuation multiples here.
So Terry, what are some of the upsides of a strategic purchase if you were looking to make an acquisition?
Well, so strategic acquirers, basically, they have synergies, that they can apply to any deal situation. And so they get revenue synergies, which is maybe they get a new customer base. Maybe they get scale, which can play with revenues as well. They get more plants or more capacity, so they can, produce more and get some more revenue. They have a lot of synergies on the revenue lines, and then same with costs. They can remove redundant costs.
So
maybe
even though they might be paying a higher valuation, there could be some definite financial upsides to making a strategic
exactly
this year.
exactly. And then like the same thing. Like I know a lot of people on the strategic buy side, and they go through 5-year plans like most well-managed businesses do. And there's a parameter out there. They if you look at almost every public company, they've got growth internally and then M&A growth. And so sometimes when you put a plan out and you say, hey, we got to use M&A to grow, that means they're going to pay a lot more maybe just to get, that plan accomplished. So you don't get called on the carpet like, how come you never bought anything over the last 5 years to make the deals happen? So, okay, next slide. Just talk a little bit about financing. We segued into this a little bit. You can see here, this is just a little bit of a busy chart. But if you look at the base of it, the orange line, it is the debt component, the senior debt component. You can see that that's declined, through year-to-date 22. And then the equity component is increased. And again, that's because of the more conservative nature of the bank lending environment. On the next slide, just goes through volume. And I'm looking at, there's some questions here. I just want to focus on the slides for a moment and then handle the questions. But you can see that volume of loans has declined this year. And I think a lot of it is just because of the more conservative nature of the bank lending community. Cycle to the next slide. A couple things I want to point out. We follow, obviously, the financing rates. For us, it's very important to look at, prime for some of the lower end middle market companies, and then SOFR, which is the new LIBOR, and the base pricing rate for loans. The key takeaway here, and prime is a good example. You can see the Fed policy of, they've raised interest rates, their guidance on Fed funds rate from 4.25 to 5.25, and no surprise, prime rate is up, 4.25, I believe here. And then the one thing that we look at, or I look at, is the 2 10-year Treasury differential, the yield curve balance, if you want to call it that, or upward or downward sloping. Go to the next slide. You can see here that the green line being last year end, we had a nice upward sloping yield curve, implying a normal inflationary environment. And then, look, the mess on the top of the slide, which is this year, with basically, as I think Spencer mentioned, you can get a great value in a 2-year Treasury now because it's around 4% or above. But yet, like a 10-year Treasury is lower than that. And that's a very crude methodology of pointing to a recession. Usually when you get an inverted yield curve somewhere down the road, a recession could occur. And the economists can address whether that makes sense or not. But I look at that as just a marker. And then the final slide on this is just, again, a look at leverage. And this is just a fragmentation of debt. And the green bar is senior debt. And you can usually go out and borrow about 3 times senior debt. And then there's something called mezzanine debt, which is quasi-debt, quasi-equity. And in the current deal environment, that's still a little component. But the big message here is that you can see there's kind of a declining debt usage by deals in the deal business. So if I can just summarize real quickly here, and I know we're getting really close to the end, basically the number of deals is declining, but deals are still getting completed. So takeaway is, even though there's declines, that means supply's down. And if you've got something you want to sell, there's probably a way to go about selling it. The other thing too is, at least through 2022, valuations have been relatively high and have been sustained. And so it's an environment where you can consider a sale and still get the value that you want. But not every company is going to see that. And it's going to be very important to think like a buyer and get your company that you're selling to look, like what the buyers are interested in. And so in a market like this, preparation, and again, I'm addressing from the sell side, Kathy, and I'll talk on the buy side in a sec. But you got to think like a buyer and, really critically analyze your company, look at its value drivers, know what makes your value and how you can emphasize that to a buyer. And then critically analyze your management depth, any issues you've got in your company. Because in this kind of environment, the buyers, it used to be a seller's market in 2021, and now it's a little bit of a buyer's market. And so you got to make sure that you dress yourself up to be good for the buyers.
Thanks so much. I really appreciate, I know we are getting at time, but I did want to circle back to one question that came in. I think it's a great question to end on. We talked about recession probability. I'm wondering if you could all just take a minute to answer your take on severity and longevity. So Jason, let's see how your volume's coming in. Would you mind taking that question?
Sure. And I would say 90% in the next 6 months, and I would anticipate that to be short and shallow, and 8 months, and shallow less than a 1.5 or 2% decline in GDP.
All right, so it'll be the next 6 months, happening in the next 6 months, and short and shallow. So I love that. Spencer, what is your sense?
Yeah, it's really hard to say before we really get into the data. What's really challenging about a recession is it depends a lot on how policymakers respond to it. When markets are selling off, unemployment's going up, is somebody going to step in and do something? Is the Fed going to pivot? Is the government going to enact more stimulus? So it's really hard to say how long or deep a recession might be, but our sense right now is that the Fed is so committed to fighting inflation that they're not going to pivot their policy at any point this year.
All right, and Terry,
Yeah.
your thoughts?
Well, so I'm not smart enough to be an economist, but I listen to a lot of economists in the conference board, which I think is a consortium of economists. They're predicting that the first three quarters of 2023 will be negative GDP growth, but very modest. And then the fourth quarter is going to spring back and be very strong, such that next year, I think they're calling for 0.2% GDP growth. And then that's following this year at 2%, which is what they think the final estimate will be. And I'll go with that. But Jamie Dimon and others like him, also agree there's some modest or light recession coming.
All right. Well, I'd love to take you all up on returning next year to see how your predictions net out. So, with that, I want to just go ahead and thank you all for being a part of today's session. I know there were some challenges, so I really appreciate the audience staying with us. So thank you to each of our guests, Terry, Jason, and Spencer, and their information is up on the slides. So please feel free to reach out if you've got some direct questions. If you put business as unusual in the subject line or in your outreach in LinkedIn, they will know that your question is coming from our session today. So I also would like to thank our sponsors, Insperity, HR Source, and M3, and tell you a little bit about our February session. So in February, we are going to be featuring one of our sponsors. Skip Miller is from M3, and we're going to be talking about outbounding, a better way to grow sales. So most organizations want to grow through organic sales, but quality inbound leads are drying up, and most aren't seeing the results they want in their marketing and sales efforts. So something really has to change. Selling in 2023 is very different from what it was just a few years ago. And people are not answering the phones or even working in the office anymore. So face-to-face conversations, networking events, and lunches even happen less than before. So one of the ways that we help companies level up their sales and marketing strategy is around proven best practices. And we don't just make it up as we go. So we're constantly refining our approach based on what we learn from market experts like M3 Learning. And Skip will share insights from his research and surveys that they've conducted with top sales executives over the past 15 quarters. They're going to share a few trends in changes in what is expected in sales in 2023, and then some of the challenges you should expect if you're trying to do more with less in your sales strategy. So he's going to be sharing how to focus your time, how to shorten the sales cycle, and then most importantly, he's going to be sharing from his book, how to instantly become better at outbound sales. And we'll be giving out a few books to those of you that attend. So it's going to be a really exciting session. And I think, sales is going to be a really important factor in all our organizations this year. So, anything we can do to improve those outcomes will be worth the time. So again, I want to thank our audience and our panelists for joining us today. If this is your first Business as Unusual, give yourself some kudos for investing in being a more informed leader. Knowledge is a powerful tool in your business strategy, and we know that growth is a choice. So if you're still unclear about where to start and what to invest in, let's connect. And we look forward to seeing you next month. Thanks again, Terry, Spencer, and Jason, for your time today.
Thank you.
Yeah, thank you, everyone.